go long or go home. That could be the new rally cry in the bond market after President Biden's Treasury Secretary pick reopened the debate on a 50-year Treasury note. At a confirmation hearing on Tuesday, Janet Yellen said she'd be very pleased to look at issuing long-term debt to help pay America's bills. Check out the reaction to those comments that day. The spread between the 5- and the 30-year Treasuries spiking on the remarks. So we thought we had to bring in Steve Leisman to get to the bottom of this. Steve, good to see you. Thanks for joining us this evening. We talked a little bit about this offline yesterday, and in my simplistic thinking, I immediately thought that previous buyers or current holders of 10 and 30-year debt would then migrate to the 50-year, and that would cause the yield curve to spike. What do you say to that argument?
No, I would never say your thinking is simplistic, Melissa. That's the first thing. I don't think you're wrong about that, but there's an awful lot that would be going on here. One is that, where would the actual demand come from? Would it come from the 20 and 30-year end of the spectrum? Would it migrate over to the 50? Would it come from the 10-year end of the spectrum? And what would it be relative to what the government would otherwise be putting out? In other words, the government has an awful lot of debt to finance. Would the introduction of a 50 mean that there would actually be less issuance in the 10-year and more on the long end? But before I do that, Melissa, before we go on, I just want to show you why it would make sense for the government to issue a 50. Do you know those commercials where they say, order one of these flashlights and get the second one free? Mm-hmm. That's kind of like the way it is with the long end of the curve right now. The market is giving the government 10 years for less and less money. So take a look at this chart that I put together. It costs the government 105 basis points, or it offers 105 basis points to issue the first 10 years. The second 10 years, in other words, between the 10 and the 20, is 57 basis points. Between the 20 and 30 is 20 basis points. So you practically get the last 10 years, or the third flashlight almost comes for free. So that's why Janet Yellen is and others are looking at it. By the way, they're going crazy with these things, issuing these things throughout Latin America and South America, issuing 50-year notes. So the idea would be, now it should be the other way around, of course. The long end should be costing you more, but either because the Fed is involved or because there's just a huge demand for liquidity, for duration, and reaching for the long end and reaching for yield, it goes the other way than how it otherwise should.
Steve, it's Karen. Thanks for being on. Let me just ask you something. If they were to sort of test the waters with a 50-year, if the Treasury were to do that, would the Fed not buy on that just to see what other kind of demand showed up? Or would they want to go along and show that there is demand for it?
I think that's an excellent question, Karen. I don't honestly know the answer to that. I do know that Steve Mnuchin, the former Treasury Secretary, was pretty hot and heavy to issue a 50, but he found out from dealers concerned about liquidity. They were afraid that there wouldn't be a big enough of an issuance or enough demand and enough liquidity to continue making it a robust part of the tenor of what the U.S. government issues. So it's unclear, and I would think that your idea, Karen, about that the Fed should operate, but I don't think, Karen, the Treasury would go forward without pretty good assurance that both the end users and the dealer community would be behind such an issuance.
Hey, Steve, it's Tim. So even though moving way out the maturity curve when the deficits are huge seems like the golden road to unlimited devotion, I think you've got a case with a $21 trillion Treasury market that 10 to 15 billion a year in 50-year supply wouldn't mean anything. And for 10 to 20 years before there was enough in supply. Does that make sense to you? Because we've heard about this before, and yet nothing ever happens.
That's right. Tim, I just want to throw something back at you. You're more of the international guy on the panel here. Are you at all dipping your toe into some of these foreign bonds here at the 50-year tenor? I mean, I don't know if that's in your bailiwick or your portfolio, but I'd be interested because there seems to be, there was a Mexican issuance of 50s, and it was oversubscribed by more than 3 to 1.
Mexico and even Saudi Arabia, and if you think about the negative real rates, emerging markets for all their glory, you have even deeper negative real rate territory. I think risk reward is not good. So chasing long duration, I don't have to do that. in my portfolio, so I've avoided it. But clearly, I think that's been part of the inspiration between if these less less creditworthy sovereigns are able to issue so easily, why shouldn't we when our deficit is ballooning?
Steve, one last question for you. As we had mentioned before, it seems like many Treasury secretaries have gone down this road. What are the odds, do you think, that Janet Yellen pulls it off, given the environment?
You know, looking at that chart, which I made today, I don't normally follow those spreads across 10-year horizons. It looks mighty attractive, you know, and you know, calling up that chart, if you look at it, you know, if they don't refinance it, or if they don't do a 20 or 30 or 50, you know, you look at it again, if you keep it the same, then the next time you go around, it costs you 105. But if you take out a 20, it only costs you 57 for that next 10. So I don't know, Melissa. I think it's awfully attractive. I'm not 100% sure what the dealer's problem is with it. I think what Tim was talking about was really interesting, that, you know, you can establish a market in this as a regular part of it. And you might as well, sort of as Karen suggested, you might as well try. So there's a pretty good logic behind it, and I need to understand more about why the dealers are skittish of it. Who I talked to a couple today who are a little bit concerned about the liquidity in that market.
And let us know what you find out about the thinking about the impact to the yield curve. We'd be interested in that as well. Steve, good to see you. Thank you as always. Steve Leisman. Guy Adami, what do you think about all of this?
I think it's how you package it. You know, you think about what happened 70 or so years ago, war bonds. You think about how, you know, a country sort of was able to wrap their head around it and get behind something that made sense. I mean, again, I don't do this for a living, but I would say if you package this as, you know, 50-year COVID bonds and open it up, I mean, maybe the demand would be such that it would make sense. Again, it's all in the packaging to me with a security of this duration, if that, you know, if that makes any sense whatsoever.
I've always thought a recovery bond would be an easy sell out there. Dan, you had a really interesting take in terms of what this could mean and the implications of this to tax policy.
Well, thanks. Two simple thinkers, Mel. Simple Dan. I mean, my takeaway was that, you know, Yellen bringing this up kind of signifies the fact that maybe the Biden administration, which really will only have in the next 2 years one ability to push through some big legislative sort of initiative, and it won't be taxes. They will not be able to kind of raise taxes. So why not borrow at 50 years at what, the 30 years at 1.83 or something like that? Why not borrow like that and get in a ton of money so you can actually then go and do the infrastructure and the fiscal? We know that the Fed has just tacked on $3 trillion onto their balance sheet. We know the Treasury is operating at massive deficits. So my takeaway is they're not going to get to taxes in the next couple of years.
Shepard Smith here. Thanks for watching CNBC on YouTube.